ETFs, exchange-traded funds, are rising quickly in popularity. The inflows are now beginning to outpace mutual funds in the market, and there's a reason why all of this is happening. And I'm going to do this series of videos to explain, 1, what ETFs are, 2, how they work, and 3, why they're gaining traction in the market, largely because of their tax efficiency. They're able to trade intraday. There's a larger variety of ETFs versus traditional mutual funds. So all these different things we're going to cover so you have a better understanding of why this trend is happening. The first video in our ETF series is understanding what an ETF is. So ETF stands for Exchange Traded Fund. And what it is, it's an investment holding made up of a lot of sub-holdings. So if you look at like the Vanguard 500 Index ETF, it has the 500 stock holdings in the S&P 500 Index, and that ETF is just trying to mimic the performance of that broader index. But you can have passively managed ETFs that are just trying to mimic an index. You could have active managed ETFs that are actually trying to beat an index. But the main difference between an ETF and a mutual fund is how they are traded during the day, the tax efficiency of an ETF versus a mutual fund that investors have to be aware of, as well as the costs associated with each of those securities. Lesson number 2 in the comparison between ETFs and mutual funds is when they trade. So an ETF can actually trade anytime during the stock market day when it's open, where a mutual fund, when you place a buy and sell order, all those buy and sell orders execute at 4 p.m. at market close at the same price. So if you're an investor that's ETF, and let's say the Vanguard S&P 500 Index ETF, and you want to sell at 10 a.m., you get the price at whatever that's trading at 10 a.m. If you have the Vanguard S&P 500 Index Mutual Fund, that mutual fund is going to trade at a price at wherever the market closes at 4 p.m. Lesson number 3 in our ETF series is how ETF shares are sold. So as the name implies, exchange-traded fund it's an exchange between a buyer and a seller. So if you want to sell shares of your ETF, you need to have a buyer who wants to buy your shares, which is different than a mutual fund, where if you want to sell your mutual fund, the mutual fund company has to redeem your shares for cash. You don't have to go searching for a buyer. Lesson number 4 in our ETF series, which is a big one, is the tax efficiency of ETFs versus mutual funds. When you sell a mutual fund share, you go redeem them to the mutual fund company. A lot of times that mutual fund has to sell securities to raise cash. And then when they sell those securities, it can create capital gains for that mutual fund company. And then they distribute those capital gains to the existing shareholders, even though the existing shareholders did not redeem any shares from that mutual fund company. Where an exchange traded fund, it's an exchange between a buyer and a seller. There is no redemption to raise cash at a mutual fund company level. So those holders of ETFs do not have those capital gains distributions each year like mutual fund investors have. Lesson number 5 in our ETF series is ETFs do not have minimum purchase requirements. When you look at, let's say, the Vanguard S&P 500 Index Fund, VFIAX is the ticker, it has a $3,000 investment minimum, which means your first purchase has to be at least $3,000. Otherwise, you can't purchase that mutual fund share class. Versus if you went in today and bought the Vanguard S&P 500 ETF, the share price right now is $525 per share. You just need enough money to buy one share. So a lot of times these ETFs give you access to investments that you might be blocked in a mutual fund that has some type of minimum initial investment. The 6th lesson in our ETF series is the variety of ETFs that are available in the marketplace compared to traditional mutual funds. There are just a lot more ETFs. You can get very strategic with the investment strategy. If, for example, you wanted to invest in Brazil's stock market because you think it's going to appreciate more than the US stock market this year, there is actually an iShare Brazilian ETF that tries to replicate Brazil's stock market performance that you can go invest in. So again, the ETFs allow you to get very strategic with your asset allocation within your portfolio, where those options may not be available to a traditional mutual fund. Lesson number 7 in our ETF series is understanding the liquidity risk associated with ETFs, exchange traded funds. Because with the ETFs, you need a seller and a buyer to complete your transaction in order for it to go through. And if you are in what's called a thinly traded ETF, like there aren't a lot of shares being transacted every day, and let's say the average daily volume is 100,000 shares and you're trying to offload 200,000 shares, you might not be able to fulfill that all in one day, so you can't sell your shares. And if all of a sudden something happens in that market, there might be no buyers and you're stuck in that holding, versus if you're in a very broad ETF, like the Vanguard S&P 500 ETF, they might trade, millions of shares a day within that ETF. So it's very easy to buy and sell, even if you're selling larger portions of your holding. Lesson number 8 in our ETF series is understanding the difference between passively managed ETFs and actively managed ETFs. So passively managed ETFs, just like passively managed mutual funds, they're just trying to replicate an index, where it's the S&P 500, the Russell 2000, where actively managed ETFs, that fund manager of that ETF is trying to outperform a certain benchmark through their investment strategy. Now, naturally, because there's active management, active managed ETFs tend to carry higher internal expense ratios versus passive funds just in general tend to be lower because there's not that active strategy being implemented.